Hello, this is the 29th episode of What Would Peter Lynch Do, which explores the wisdom of legendary investor Peter Lynch. Today, we're tackling a really fascinating and honestly incredibly risky corner of the financial world. One of our listeners asked, please explain short selling. Some people have made a fortune from short selling. Should I, an individual investor, try it? So our mission in this deep dive is to pull back the curtain on short selling. We'll break down how it works, the mechanics, and maybe more importantly, expose the inherent risks. We want to figure out whether it's actually a suitable strategy for you, an individual investor, drawing insights from the sources you've shared. This is definitely a topic where understanding the pitfalls is, well, paramount.
That's a really excellent question, especially because short selling, it often grabs headlines. You hear stories of these massive wins, but also catastrophic losses. Usually when we talk about investing, we think pretty simply, right? Buy low, sell high.
Right, that's the classic approach. You buy a stock hoping its value goes up over time. Seems straightforward.
It does. That's the bedrock of most investing, like you said. You believe in a company, buy its shares, hold them, hope they grow. Feels intuitive. But short selling, it flips that entire concept right on its head. It's essentially a bet that a stock's price is going to fall. You're aiming to sell high and then buy low to return the shares.
Sell high first, then buy low. How does that actually work?
Well, the core process, particularly in the U.S. market, starts with you borrowing shares you don't actually own.
Borrowing shares. From who?
From a brokerage firm, typically. It's called the securities lending transaction. And importantly, you need to put up collateral, margin for these borrowed shares.
Wait, so you're borrowing something you don't own?
Correct. And then you immediately sell those borrowed shares at the current market price. That puts cash into your account.
Right, so you sold something you borrowed, then what?
Then you wait. You play the waiting game, hoping your prediction is right, and the stock price drops. If it does fall, then you buy the stock back, but now at that lower price.
Ah, okay. And then you give those shares back to the broker you borrowed them from.
Exactly. You return the shares to the brokerage, and your profit is the difference.
So the money you got from selling minus the money you spent buying it back.
Precisely. Money received minus money spent equals your profit.
Mm.
But, and this is important, you also have to subtract the fees.
Fees? What kind of fees?
There's usually a stock loan fee, often charged daily, for borrowing those shares. That can definitely add up, especially if you hold a short position for a while.
Okay, let's walk through an example. Say ABC company. It's trading at $100 a share.
All right. And you think it's going down?
Yeah, I'm convinced it's overpriced. So I decide to short it. I borrow, say, 10 shares from my brokerage.
Okay, 10 shares at $100. You immediately sell them.
Right, so I get $1,000 in my account minus any immediate transaction costs.
Correct. Now you wait. Let's say you're right. Some bad news hits ABC.
And the stock drops. Let's say it falls to $70 a share.
Perfect. So now you need to return those 10 shares you borrowed. You go into the market and buy 10 shares at $70 each.
That cost me $700.
Right. You take those 10 shares you just bought, give them back to your brokerage. You initially received $1,000. You spent $700 to buy them back.
So $300 profit, minus those loan fees you mentioned, of course.
Exactly. That's short selling in a nutshell when it works. It's about profiting from a falling market or a specific stock falling.
Okay, that makes sense when it goes right, but what happens if it goes wrong? This feels like it could get ugly fast.
Oh, it absolutely can. Let's use that same ABC company example. You shorted 10 shares at $100, got $1,000.
Right, but this time, instead of falling, the price goes up, say, to $130 a share.
Now, you still have to return those 10 borrowed shares, but to buy them back in the market, it's going to cost you $130 each.
So 10 shares times $130, that's $1,300 I have to spend?
Correct. You got $1,000 when you sold, but you spent $1,300 to buy them back.
That's a $300 loss. Ouch.
Exactly. And this brings us straight to the biggest, most fundamental, and frankly terrifying risk of short selling.
Which is?
The potential for unlimited losses.
Unlimited? How is that possible?
Think about it. When you buy a stock, the most you can lose is what you invested, right?
Right.
If the stock goes to zero, you lose 100% of your money, but that's the cap.
Okay, yeah. My loss is limited to my initial investment.
But when you short sell, you're betting the price will go down. What if it goes up instead? How high can a stock price go?
Theoretically, there's no limit, right? A $100 stock could go to $200, $500,000, $1,000, even higher.
Exactly. There's no theoretical ceiling on a stock price. So if you've shorted it, your losses keep mounting as the price climbs higher and higher. Your potential loss isn't capped at your initial collateral. It could, theoretically, be infinite.
Wow. Okay, that's a fundamentally different kind of risk than just buying a stock. Unlimited downside.
It's a complete game changer, and it's why many experienced investors argue it's just not suitable for most individuals. Peter Lynch's advice, never invest in any idea you can't illustrate with a crayon,
Yeah.
really hits home here. How do you draw potentially infinite losses?
You can't really. That uncapped risk is a massive red flag. Are there other major risks besides just the price going the wrong way?
Absolutely. Another huge one is the risk of a short squeeze.
A short squeeze, I've heard that term. What exactly happens there?
Okay, imagine a stock that lots of people have shorted. They're all betting it will go down.
Mm.
But then suddenly, maybe due to good news or coordinated buying, the price starts to surge upwards.
So the short sellers are losing money.
Exactly. They're losing money fast. To stop the bleeding, they need to buy back the shares they borrowed to close out their positions. This is called covering. They're short. But if everyone who's shorted tries to buy back the stock at the same time,
That creates huge demand for the stock, which pushes the price up even faster.
precisely, this is a vicious cycle. The rising price forces more short sellers to cover. Their buying pushes the price higher still, triggering more covering. It becomes a frantic scramble, a buying panic that can send the stock price soaring exponentially and inflict devastating losses on anyone caught short.
Like a stampede, you said earlier. I remember the GameStop situation seemed like that.
That was a classic, albeit extreme example. And don't forget those interest costs we mentioned.
Right. The daily loan fees for borrowing the shares.
Yeah, those fees keep accumulating every single day you have the short position open. If the stock price doesn't fall quickly, or if it just trades sideways, those costs can eat away at any potential profit or make your losses even worse.
Okay, so unlimited loss potential, short squeezes, and borrowing costs. Anything else?
Yes, one more critical danger, the risk of forced liquidation, which usually starts with something called a margin call.
Ah, the margin call. That sounds ominous. It often seems like the point of no return, especially for individuals. What exactly is it?
A margin call is basically a demand from your brokerage firm. They're telling you to deposit more money or securities into your account, additional collateral.
Why would they do that?
It happens when your losses on a position, like a short sale, get too big. Your account's equity, the value of your assets minus what you owe, falls below a certain required level, called the maintenance margin. Think of it like this. The broker lent you those shares, right? They need to be sure you can cover the position if it goes badly against you. When your losses mount, their risk increases, so they demand more security from you.
So it's the broker saying, hey, your bet is going south, and we need more cash from you now to make sure we don't lose money if things get worse.
That's a good way to put it. Let's trace how this can lead to, well, financial peril. You open the short position, putting up some initial margin, your collateral.
Okay.
Then the stock price goes up, the opposite of what you wanted. Your position starts showing a loss.
Right.
As that loss grows, the value of your collateral relative to the rising value of the shares you owe effectively shrinks. If it drops below the broker's minimum requirement, the maintenance margin boom. Margin call.
And they demand more funds. How much time do you get?
Usually not much, maybe just 1 or 2 business days. You have to deposit additional funds or securities to bring your account equity back above the required level.
And if you can't, if you don't have the extra money.
This is the really dangerous part. If you fail to meet the margin call in time, the brokerage doesn't wait. They have the right to forcibly liquidate your position. In the case of a short sale, they will go into the market and buy back the shares needed to cover your borrowed position. This is often called a buy-in.
And they do this whether you want them to or not, even if you think the stock might turn around.
Absolutely. They do it to protect themselves. They buy back the shares at the current market price, whatever it is, locking in your losses.
Wow. So you lose control and your loss gets crystallized potentially at the worst possible time, like during a short squeeze when the price is spiking.
Exactly. And remember that unlimited loss potential. If the losses locked in by the forced buy-in exceed the total collateral you had in your account.
You owe the brokerage more money, money you might not have.
Precisely. This is how short selling can lead not just to losing your investment, but to significant debt, potentially even bankruptcy for an individual. It's a very, very serious outcome.
Okay, hearing all that. Let's circle back to our listener's question. They're an individual investor, maybe just starting out, and asking, should I try short selling? After everything we've discussed, it sounds, well, incredibly dangerous for someone like that.
It really, really is. I'd go so far as to call it a poisoned chalice for most retail investors. And let's just recap why, clearly. First, and it absolutely bears repeating.
Mhm.
Unlimited loss potential. This isn't like buying a stock where your loss is capped. With shorting, a stock going against you can theoretically wipe out your entire net worth and leave you owing massive amounts of money. That alone should be a huge warning sign.
Absolutely. And the short squeeze risk we talked about, how does that play out for an individual versus, say, a big hedge fund?
It's incredibly tough for an individual. You likely don't have the same information, the same speed, or the same capital reserves as institutions. Remember the GameStop saga?
Oh, yeah, GME? That was wild.
It was. You had hedge funds with massive short positions, betting the company would fail. Then, individual investors, coordinating largely on Reddit's Our Wall Street Bets, started buying heavily.
They spotted the heavy short interest and piled in, right?
Exactly. This huge buying pressure sent the GME stock price into the stratosphere. It triggered a massive short squeeze. The result? Billions in losses for some hedge funds. Now, some early retail buyers made fortunes, yes, but many individuals who jumped in late, chasing the rally.
They got burned when the price eventually crashed back down.
Precisely. It highlights how unpredictable and dangerous these situations are. If you're an individual short seller caught on the wrong side of a squeeze like that, it can be financially devastating almost instantly.
So, besides the unlimited risk and the squeeze potential, what other disadvantages does an individual face?
There's a significant disadvantage in information and capital. Institutions have teams of analysts, sophisticated data feeds, and huge amounts of capital. They can access information faster and deploy capital more effectively. Retail investors often face information asymmetry. They just don't have the same resources.
And those borrowing costs.
Yes, the interest costs. Those daily loan fees add up, especially if your short bet takes time to play out or never does. Plus, actually finding shares to borrow for certain stocks, especially ones that are already heavily shorted, can be difficult or very expensive for retail accounts. Sometimes the shares just aren't available to borrow.
So, all things considered.
All things considered, short selling is extremely risky, complex, and stacked against the individual retail investor in many ways. There are far wiser investment strategies with much more manageable limited risk profiles available. Honestly, for most individuals, especially those starting out, it's something to understand maybe, but definitely not something to attempt.
That brings up another point related to risk and leverage, though maybe not directly short selling initially. Our listener mentioned the Swiss bank incident. I assume they mean the Credit Suisse crisis involving Bill Hwang's Archegos Capital. That was a huge story.
Ah, yes, Archegos. That's a very relevant, though complex, cautionary tale about leverage and risk. Even if short selling wasn't the initial trigger, it definitely shows how quickly things can unravel.
Right. So what happened there? It wasn't short selling that caused the main problem.
No, not primarily. Bill Hwang ran Archegos as a family office, which meant less regulatory oversight than, say, a typical hedge fund.
No.
His main strategy involved using complex derivatives called total return swaps. Essentially, banks bought stocks on his behalf, and he got the rights to the gains or losses using massive amounts of leverage. He was making huge bets that certain stock prices would increase. So, highly leveraged long positions.
Okay, so betting big on stocks going up, using borrowed money or leverage provided by banks like Credit Suisse. What went wrong?
He made similar, enormous bets with multiple banks simultaneously, and crucially, the banks didn't seem to know the full extent of his exposure across all the other banks. It was like he was building the same risky tower with different builders, none aware of the others.
That sounds incredibly risky.
It was. In March 2021, several of the stocks Archegos was heavily invested in suddenly plummeted. The value of his positions collapsed. The banks he worked with, including Credit Suisse, suddenly faced enormous potential losses on the money they'd effectively lent him. They issued massive margin calls.
Demanding more collateral, just like we discussed earlier, but on a colossal scale.
Exactly. But Archegos couldn't meet them. He didn't have the billions needed. So the banks had no choice but to forcibly sell the stocks they held for him to try and recoup their money.
Which must have driven the prices down even further.
Precisely. It turned into a fire sale, crashing the prices of those stocks. Credit Suisse was hit particularly hard, taking a staggering $5.5 billion loss just from the Archegos collapse alone.
$5.5 billion. That's immense. And Credit Suisse was already facing issues, wasn't it?
Yes, it was already weakened by other scandals and perceived mismanagement. The Archegos loss was a devastating blow to its finances and, perhaps more importantly, to market confidence in the bank.
So where does short selling fit into the Credit Suisse story then?
Here's the indirect but important link. After the Archegos disaster and seeing Credit Suisse's vulnerability, Many market participants lost faith entirely. They concluded the bank might not survive. What did some of them do? They started to aggressively short sell Credit Suisse's own stock, betting that its share price would collapse further due to the crisis.
Ah, so the initial problem was leveraged long bets failing, but then short sellers piled on, adding pressure to the already wounded bank.
Exactly. This wave of short selling put immense downward pressure on Credit Suisse's stock price, shaking confidence even more and contributing to a snowball effect of client withdrawals and market anxiety.
Which ultimately led to its forced sale to UBS.
Correct. Credit Suisse was effectively rescued via an emergency acquisition by its rival UBS in March 2023, ending its 167-year history. So, to summarize, Archego's disastrous leveraged long bets inflicted the initial critical wound on Credit Suisse. But the subsequent market reaction, including significant short selling of Credit Suisse's own stock, acted like pouring salt in that wound, exacerbating the crisis and demonstrating how short selling can amplify pressure on vulnerable companies.
That's a stark illustration of market dynamics. Okay, let's bring this back home to the core of our show, the wisdom of Peter Lynch. What's a key piece of advice from him that really connects with everything we've discussed about short selling?
Well, I think a powerful word from Peter Lynch today, especially relevant here, is this quote: "If you don't study to become a good stock picker, then don't invest in stocks, period."
Classic Peter Lynch, direct, no nonsense.
Exactly. And while he was talking about picking stocks to buy, the principle applies perhaps even more strongly to something as complex and dangerous as short selling. What he's really hammering home is the vital importance of understanding what you are doing. Do your homework. Know the risks inside and out. Acknowledge the complexities. If you haven't thoroughly studied short selling, if you can't explain the mechanics, the risks like unlimited loss, short squeezes, margin calls, if you don't grasp the odds stacked against an individual, then following Lynch's logic, you absolutely should not be doing it.
It extends beyond just investing too, doesn't it? That idea of knowing your limits and avoiding ventures where you lack real expertise.
Absolutely. It's fundamental life wisdom, really.
Yeah.
It's about self-awareness, acknowledging complexity, and making prudent decisions based on genuine understanding, not just hype or a desire for quick profits. Whether it's finance, starting a business, or any significant undertaking, knowing what you don't know is crucial.
A really important takeaway. So a final thought for you, our listener, to consider, given all these complexities and the truly significant risks we've unpacked, the unlimited loss potential, the short squeezes, the margin calls, how does understanding the dangers of short selling reinforce the critical importance of building foundational knowledge and performing rigorous risk assessment in all your pursuits, financial or otherwise? Something to definitely mull over. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.